Good evening, unit holders of ARA LOGOS Logistics Trust. Thank you for joining us today at the SIAS-ALOG virtual information session. We last met on 14th of January to look into the proposed merger of ALOG and ESR-REIT by a trust scheme of arrangement. Then on 22nd of January, the scheme was revised following recommendation by proxy advisors for ALOG unit holders to receive a better share of the benefits of the merger. Under the revised scheme consideration, ALOG unit holders will now receive 0.097 in cash from 0.095 and 1.7729 new ESR-REIT units from 1.6765 per ALOG unit. You unit holders will be eager to know how this revised scheme consideration will benefit you and your investments. What are some key developments over the last 5 months since the merger was first announced? To help you understand, we have invited the senior management of ALOG to join us at this dialogue. But you will also be pleased to note that 2 days ago, the proxy advisors ISIS have advised unit holders of ALOG to vote in favor of the resolutions, although ISIS has given a cautionary for. So in order for you to understand the issues and to help you make an informed decision, we have invited Ms. Karen Lee, Chief Executive Officer, Manager of ARA LOGOS Logistics Trust. She will share with you some updates on this transaction, as well as to provide you with more relevant information. We will also address your questions. So please submit your questions via the pigeonhole link sent to your email. Okay, without further ado, I will now invite Ms. Karen Lee to take us through the presentation to explain the transaction once more. Over to you, Karen.
Good evening, everyone. Thank you, Mr. Gerald, for the introduction. First of all, I would like to thank SIAS for hosting this virtual dialogue, and a very big thank you to our unit holders for taking time to join us in this session. It's been almost 5 months since we announced the proposed merger between ALOG and ESR-REIT. So let me quickly recap what this transaction is about. Together with ESR-REIT's manager, we jointly announced the merger of ESR-REIT and ALOG on 15 October last year. Sometime in mid-January, upon receiving feedback from unit holders and proxy advisors, ESR-REIT revised its offer to ALOG, and their revised offer was announced on 22nd January. At this stage, we also understand from articles published by The Edge Singapore and the Business Times that the proxy advisors, Glass Lewis and Institutional Shareholder Services, or ISS, have recommended ALOG unit holders to vote for the resolutions relating to the proposed merger. This is a straightforward revised offer, which is higher than the original scheme consideration. In this revised scheme consideration, the consideration units will increase from 1.6765 to 1.7729, representing a 5.8% increase from the original offer in the number of ESR-REIT units ALOG unit holders will receive. For the cash component, it will increase from 9.5 cents to 9.7 cents, representing a 2.1% increase from the original offer. For illustration, this means for every 1,000 ALOG units held, a unit holder will receive $97 in cash and 1,772 consideration units. And with this higher offer, there is no reduction in the ALOG permitted distributions due to our unit holders. There are also no other changes to the other terms previously disclosed in the original scheme document. The only change here is the scheme consideration. This slide shows a comparison of the improved offer to the original one. While the illustrative offer price has increased from 95 cents to 97 cents, we would like to highlight here that it would not be accurate to just look at it as a 2.1% increase. If we look at the illustrative price for ESR-REIT unit, it has decreased by 3.5% from 51 cents to 49.24 cents. This means more consideration units will be issued to our ALOG unit holders. The more objective way to look at this is the increase in illustrative value of the scheme consideration for ALOG unit holders. For illustration and to ensure a like-for-like comparison, based on ESR-REIT's 1-month VWAP, which was about 47.13 cents, the implied value of the revised offer is now 93.3 cents versus 88.6 cents calculated the same way in the original offer. This now represents a 5.3% increase in the illustrative value from 88.6 cents to 93.3 cents. It is also important for our unit holders to note that the transaction remains accretive on a historical pro forma basis, where the historical FY 2020 pro forma DPU accretion improves to 12.8% from 8.2%, and the historical FY 2020 pro forma NAV accretion improves to 5.3% from 2.2%. When we first presented our original offer from ESR-REIT to our unit holders, we focused a lot on articulating the merits of the merger, as this is not a selling out of ALOG. Our unit holders will benefit from an enlarged platform. Hence, I feel that it is important to ensure we are able to explain clearly how we will grow the enlarged REIT in the long term and in the sustainable manner. Regarding the revised proposal, there are 3 broad considerations. Firstly, the financial merits of the revised offer have improved. The illustrative value of the revised scheme consideration has increased by 5.3%, and this also represents a premium in the range of 0.5% to 31.2% across the 1 month to 24 months VWAP of ALOG units. Our historical FY 2020 pro forma DPU accretion of 12.8% is the highest amongst the 5 completed S-REIT mergers since 2018. In addition, the historical FY 2020 pro forma NAV accretion improves to 5.3%. The implied price over NAV of 1.4 times is also the highest for any precedent S-REIT merger or privatization since 2014. Secondly, the merger remains a win-win proposition. Our ALOG unit holders will benefit from the creation of a leading new economy APAC S-REIT with access to the sponsor's 59 billion new economy AUM pipeline and 10 billion work-in-progress development pipeline. This is a large pipeline made available to a REIT from an S-REIT sponsor, and this demonstrates that there is a clear pathway for growth. Given the enlarged scale and considering both REITs are already in the FTSE EPRA Global Developed Index, we will expect the weightage in this index for the enlarged REIT to increase, and this will potentially attract additional institutional investors, enhance trading liquidity, and lead to a potential re-rating for the enlarged REIT. The enlarged REIT is also well positioned for potential investment grade rating, and we would expect once a good rating is obtained, this should allow the enlarged REIT to access more sources of competitive funding. Finally, another important consideration is the potential overlapping mandates that will arise with the 2 REITs now sharing a common sponsor, ESR Group, post the completion of the acquisition of ARA by ESR Group. The proposed merger will be able to resolve this overlapping mandate issue. As a single platform, we can be more efficient in relying on our sponsor's resources, including tapping on its global operating network and asset pipelines. If we remain as 2 standalone REITs, I believe our sponsor would be indifferent and treat both REITs fairly. but the two REITs would have to compete for the same sponsors' assets, resources, as well as third-party pipelines. Hence, we believe being a standalone REIT under such circumstances will not be beneficial for either REIT, and we believe that the merger will be in the best interest of our unit holders. As shown on this slide, it is clear that with the revised offer, the premium over the various VWAPs ranges between 0.5% to 31.2%. On NAV, there is a premium of about 40% to our NAV, and this premium already reflects the high quality of ALOG's assets. More importantly to note, the transaction based on the original offer and the revised offer are both DPU and NAV accretive on a historical pro forma basis. And the historical FY 2020 pro forma DPU accretion based on both offers are the highest amongst the 5 completed S-REIT mergers since 2018. As shown here, the price over NAV is about 1.4 times, which is the highest as compared to all precedent S-REIT mergers and privatizations since 2014. Again, the proposed merger is value accretive to ALOG unit holders on a historical pro forma basis, where the pro forma FY 2020 DPU accretion is 12.8% and the pro forma FY 2020 NAV accretion is 5.3%. The DPU accretion of 12.8% is the highest amongst the 5 completed S-REIT mergers since 2018. As a quick recap, post-rebranding of Cash Logistics Trust to ALOG in April 2020, and upon swiftly executing our portfolio rebalancing and growth strategy, which included the Australia portfolio acquisition from our current sponsor LOGOS, we divested 2 lower performing properties in Singapore and Australia and commenced defensive AEI works on several of our Singapore properties. Over the period from April 2020 to October 2021, just before the merger was announced, our portfolio rebalancing and growth strategy delivered tangible returns to our unit holders, as evidenced in the outperformance of ALOG's unit price of over 79% and superior total returns of over 100% as compared to some other larger cap peers. We believe the key reason for the strong performance was a result of the market pricing in the intangible benefits which our current sponsor LOGOS brings in, which include financial muscle, growth pipeline, organizational depth, and operating network. ALOG is now at an important juncture as our current sponsor LOGOS is now part of the ESR Group following the acquisition of ARA by the ESR Group. In that regard, both ALOG and ESR-REIT now share a common sponsor, have overlapping mandates, and will be in direct competition with each other. We must now collectively decide on the path that ALOG should take from here on. That is, to merge with ESR-REIT or for both ALOG and ESR-REIT to remain as standalone REITs. We and ESR-REIT believe that the merger will be in the best interest of both REITs unit holders. As mentioned earlier, ESR-REIT and ALOG currently share a common sponsor and have overlapping mandates. In the absence of proposed merger, both ESR-REIT and ALOG will have to compete for the common pipeline of new assets, operational and financial resources from the ESR Group, and will also be competing against each other for new assets and tenants from third parties. The proposed merger will address the issue of overlapping mandates in relation to asset pipeline, tenant and operational network, and financial resources, and safeguard the interests of the unit holders of both REITs. Together with our board, we have considered other options such as selling ALOG Manager or divesting ALOG's underlying assets to resolve the conflicts of interest. First and foremost, we have no intention of selling ALOG, and this is not a sale process, but a strategic merger where our ALOG unit holders are rolling over to an enlarged platform and continuing with us on a growth journey. At the same time, ALOG unit holders are able to crystallize part of their investment returns in cash at this high premium. But even if we're prepared to do so, there is no guarantee that we could achieve a better price due to a few considerations. Logistics assets currently command a hefty public market premium. ALOG was already trading at more than 30% premium to its NAV before the merger was announced. If we were to put up ALOG for sale, we need to achieve similar or higher premium to NAV so that it can be compelling to our ALOG unit holders to consider any counter-offers. Further, a sell-out of the ALOG Manager or ALOG's underlying assets will mean that our unit holders will no longer benefit from further upside associated with the sponsor pipeline and the premium which the public market is attributing to its logistics assets. As seen here on this slide, sponsored REITs enjoy a premium to NAV versus non-sponsored ones. Sponsored REITs could also access more sources of competitive funding as well. Beyond that, there are friction costs and other constraints associated with a sale. Any potential acquirer will be subject to acquiring funding, which may be limited by the asset valuation. There are also additional costs, such as transaction costs and stamp duty costs, which the acquirer will incur. If the potential acquirer is a third party, we will charge a divestment fee. For this current merger, ALOG Manager is not charging any divestment fee. Any sale process will also be constrained by regulations which strings the buyer pool. As all of ALOG's Singapore assets sits on JDC land, the potential acquirer, if it is a fund, will need to have necessary license such as a CMS license and will have to meet JTC's stringent requirements for buyers of JDC's properties. As such, this would limit the pool of potential buyers. Since this transaction was announced in October last year, there has been no competing offer received so far. Regardless, if there is a competing offer, our board remains open to consider any bona fide offer and will have a fiduciary duty to consider such offer. And this is allowable within the scheme as well. By coming together, ESR LOGOS REIT or ELOG will be the 9th largest S-REIT by free float, leapfrogging ALOG into the large cap S-REITs universe immediately, without any equity call from unit holders in a historical pro forma DPU and NAV accretive transaction. ELOG's enlarged platform enhances our flexibility and ability to drive growth. Our 5.4 billion platform of 87 properties with 2.2 million square meters of NLA will now serve a combined 437 tenants. With ESR Group's sponsorship, ELOG will be able to access more than 59 billion new economy pipeline and also sponsors 10 billion new economy work in progress development pipeline. This is a large pipeline made available to a REIT from a S-REIT sponsor, and this demonstrates that there is a clear pathway for growth where quality logistics assets are becoming increasingly scarce given the competitive landscape. Our core focus in the new economy sector will be further enhanced, providing outsized exposure to the largest secular growth opportunity in APAC. ELOG will be a future-proof REIT with a clear growth trajectory underpinned by our access to ESR Group's global network. We hope we have convinced you of the benefits of the proposed merger. With a strong track record backing us as evident from ALOG's performance in the last 12 to 18 months, my team and I will be rolling onto the enlarged REIT Manager, and we are excited to be able to continue with our commitment to delivering long-term sustainable returns to our unit holders. And we believe our unit holders will continue to support us in the transaction. Let me quickly run through the approvals required for ALOG. The two resolutions we have tabled earlier remain the same. That is, to amend the ALOG Trust Deed and to seek approval for the proposed merger. For both resolutions, we require the approval of at least 75% of the total number of votes cast. In addition, For the scheme resolution, we also require the approval of more than 50% in number of ALOG unit holders present and voting. Ivanhoe Cambridge, our second largest unit holder and one of the largest Canadian pension fund managers, have given their irrevocable undertaking to vote for the merger. And this reflects their confidence in the growth potential of the enlarged REIT. I would like to just quickly highlight the views of the independent financial advisor who has opined that the revised terms of the scheme offer are fair and reasonable from the financial point of view. ALOG unit holders are encouraged to read the full IFA opinion, which you can find in Appendix B of the revised scheme document dated 25 February 2022. Also, our independent directors have reviewed carefully and opined that the resolutions put forth at the upcoming EGM and scheme meeting would be beneficial to and be in the interest of ALOG. In this regard, our independent directors have recommended that our ALOG unit holders vote in favor of the two resolutions. ALOG unit holders are encouraged to read the full letter to ALOG unit holders, which can be found in pages 28 to 126 of the revised scheme document. The revised EGM and scheme meeting dates will be held on 21st March. And we look forward to your continuing support at the upcoming EGM and scheme meeting. So with this, I've come to the end of this presentation. Thank you. Mr. Gerald, please.
Well done, Karen. You worked very hard since October last year. What, 5 months now?
Yes, it's about 5 months.
Have you been taking a rest?
Nope.
No.
I think we have a lot to do for
a lot to do. I can see that you've been working very hard with your team.
Yes.
And look, listening to you right now is like the election campaign. You know, vote for me and you will be all right. And sure enough, you have given very good reasons why the unit holders must vote for you, for your scheme. You've got the independent financial advisor saying, go for it. You've got the independent director saying, go for it. The only lot that was not in favor was ISIS, the proxy, and Glass Lewis saying you could do better with the offer. Now, you have gone back and worked very hard to get a better offer, and you did. To ask anything more, we have to think about the shareholders of ESR who may not agree. Your story is big is better. And you, unit holders, if we are doing well now, but in the long term, you'll do better with ESR. That's the crux of your campaign.
Yeah, that's absolutely right, Mr. Gerald. Previously, I think when we have the exclusive access to our current sponsor, LOGOS pipeline, and we have delivered what we have promised to our unit holders, growing the REIT back then and sort of strengthen the portfolio metrics. We managed to achieve very strong operating metrics for ALOG. Our occupancy has remained high. The WALE has improved to about 4.4 years. And also rental reversion has been positive. So all this didn't happen just because we changed our name to ALOG, but rather we have also gotten a very strong sponsor behind us and allowing us access to its pipeline, and we are able to tap to its operating platform. So a dedicated sponsor who's aligned to the unit holders is very important, and this is evident from the ALOG's past performance.
So in spite of all these positives, all the factors that are glaring at us and which you have pointed out, which says that, look, if you vote for this, you'll do better. There are some naysayers, skeptics within the unit holders who have reached out to us. And it is only fair that this dialogue session, we address their concerns. For that reason, I'm going to ask you some hard questions and hope you will, prod along. Look, you worked very hard to negotiate for an improved offer. Is there a China wall during the negotiations, especially the two managers are owned by the same sponsor? All right. And do you think the revised offer is attractive enough for these skeptics who are saying, oh, we could get something more if we keep saying, we are not in favor? For ALOG, these ALOG unit holders, number of them are saying is good now. You've gotten rid of the proxy advisors negatives. You've got everybody along with you. So now let's try and convert this view.
Maybe to your first question, Mr. Gerald, on the question on whether there's a China wall during the negotiation. I think first and foremost, this negotiation between us and ESR-REIT, we negotiated extensively with the other side's manager, and it is always on an arm's length basis. And the independent directors on both boards are independent for the purpose of the scheme. So I would say that as with all transactions, there must be information barriers put in place. And for the purpose of this transaction itself, we only share information in relating to the merger. So information relating to our own business operations, we don't share this. So this is how we keep that China wall between us. And yeah.
Sorry, carry on.
Yeah. So and this is also despite we have the same sponsor, so we have sufficient safeguards to ensure that that China wall is between us. So on your second question, do you think the revised offer is attractive enough for ALOG unit holders? I believe I have also explained that previously. I think let me also recap this. This is a strategic merger. It's not a sell-out of ALOG. And we have emphasized enough and also emphasized several times, we're not selling out ALOG, but rather it's a strategic merger between two REITs. And if for a merger to be successful, then it has to be balanced from both perspective, and it has to be sort of balanced from both sides, unit holders. And considering that the price that's being offered on the table right now, if we recap some of the things I've said during the presentation, the offer price is now higher. And I would say that it is not right to just look at it as a 2.1% increase from 95 cents to 97 cents.
Why?
But yeah, so we need to look at the 1 month VWAP of ESR-REIT, and we'll take that into consideration. In fact, the price, the new price now for ALOG is about 93.3 cents versus 88.6 cents based on the original offer. And this is a 5.3% increase. And looking across the various benchmark, and we have also shown it in our slides, across the 1 month to 24 months VWAP, the premium is between 0.5% to 31.2%. So it's quite substantial.
And ESR may say it's not fair to call on our unit holders to keep increasing.
Possible.
Yeah, I mean, they have a limit too.
Yes.
So the next question is, proposed merger is said to be a way to resolve the existing conflicts of interest between ESR-REIT and ALOG, as ESR Cayman has completed the acquisition of ARA in January 22. However, ESR Cayman also has interest in another industrial REIT, isn't it, S-REIT. So, first question is, since there are also other industrial S-REITs under the same sponsor, some ask, is this merger necessary? All right, that is one question that they ask. And they've asked us. And then secondly, in terms of competition, if this merger is successful, how will this set itself apart from other industrial S-REITs under the same sponsor?
To the first question on other S-REITs. I don't think we can comment on the other S-REITs, but I would like to emphasize that to this conflict of interest arise because at the sponsor level, the acquisition of ARA, who holds LOGOS directly, has now been completed. Now LOGOS is part of the ESR group, and by sharing a common sponsor, we are now conflicted because both ESR-REIT and ourselves have overlapping mandates. While we are a pure play logistics REIT, ESR-REIT has a more diversified portfolio, but it also includes logistics assets. So what this means is that when we have two REITs which have overlapping mandates, it means as the sponsor would have to split their resources to support the two REITs. Like what I mentioned earlier on, I think the sponsor would be indifferent and treat both REITs fairly. But we would have to compete with one another for the sponsor's pipeline, and I don't think that will be in the interest for the REITs itself. And not only that, we also have to compete for third-party assets and tenants. So we believe that the merger will be in the best interest of the REIT and the unit holders, and we can better leverage on the sponsors' resources and network and to grow the REIT better.
So the follow-up question to
on
that
the growth
would be, the proposed merger has been is successful. If the proposed merger has been ongoing, for 5 months, and professional fees have been incurred. Some unit holders worry about this, in that there are options to, they say, waive or absorb the professional fees, since ALOG unit holders will be given new ESR-REIT units if the merger goes through. What is your response to that?
I think on the fees itself, from the sponsor's perspective, the sponsor is also dedicating some of its resources to support the REIT. So the sponsors will also expect some, investors may also expect some returns. At this point in time, the fees that we have estimated for the transaction for both sides is about 32, 33 million. And we are still well within that range. And the acquisition fee is about 15 million from ESR-REIT's point of view and from our point of view. So I think we are still within that range itself. It will be issued in terms of the REIT. But considering in the longer term, we are going to have access to the sponsors' 59 billion new economy pipeline and 10 billion work in development pipeline. And this is a large pipeline that we can tap on. And we have also articulated the merits of becoming larger. We can undertake larger transaction. We can do more. I believe all these upside will be able to far exceed the cost that will be incurred for this transaction. And just to add, for this acquisition, for this merger itself, ALOG is not charging any divestment fee. So that's a savings automatically.
That's a savings. Okay, so now let's look at market perception of the proposed merger. That is largely, I'm directing it to 0.933 or 0.859 question. Some unit holders seem to think that the illustrative value of the scheme consideration is 0.933 based on the first month VWAP of 0.4713 per ESR unit before the announcement. All right. Now, however, given that we are in March 2022, we should, and we have to, they say, consider what the market is saying right now. All right. The fact is that market has priced ESR-REIT at about 0.42 to 0.43 in the past week, even though the new issue price is 0.4924. So, according to them, the market price is roughly 15% lower. Using one month VWAP from mid-September 2021 to October 2021 seems a bit dated and irrelevant. Through the price discovery mechanisms, the market is saying the offer is only valued at 0.097 plus 1.7729, 0.43 or 85.9 cents. For reference, ALOG traded at 93.5 cents per unit before the proposed merger was announced, although the market conditions have changed since then. So the main question here is, given this background, some unit holders see the proposed merger as unattractive still. Looking at the more recent valuation, what is your response? Also, with the team busy with the merger, who is really taking care of the core business over the last 5 months?
Hard questions.
Yes.
Maybe to address the first question on the market perception on the pricing itself. I think generally the S-REIT market has seen a softening of the prices, not because of anything, but more because of the macroeconomic conditions and the macroeconomic events that's happening around the world. So that has caused some sort of a softening of the pricing. And I believe that when we look at this transaction, we shouldn't be looking at just the spot price. That is why when we come to this revised scheme consideration, we put out the analysis of taking the position of considering the pricing of ALOG's unit pricing with ESR-REIT's 1 month VWAP pricing. So this is how we benchmark. If we benchmark against that 1 month VWAP pricing before any disturbance in the market, the fact that the illustrative price is actually 93.3 cents, which has a premium of about 0.5% to 31.2% across the various VWAPs before the merger was announced. So I would say that looking at the pricing at this point may not be accurate because of the macroeconomic events that's happening.
Right. So some still say that ALOG has done, whilst they accept that ALOG has done well as a standalone REIT, why not remain as a standalone REIT? Some unit holders also ask, what are the pros and cons? They're saying, hey, Karen, shall we stay where we are? Do we need to go into this? You've given a very good explanation in your presentation, and you've given all the benefits of joining ESR. So the question is, really, do you have to do this?
Like what we have mentioned in the presentation as well, ALOG has done well. I'm happy that our unit holders acknowledge that. This is also a recognition to the team's hard work over the last 12 to 18 months.
You and your team.
Yes. Thank you, Mr. Gerald. And I would say that the tangible benefits that our current sponsor has brought in, the market has priced it in. And this intangible benefits includes, LOGOS expertise in managing logistics assets, the pipeline that LOGOS has given exclusive access to ALOG earlier on, and also its network across the geographical locations that LOGOS were in, and the tenants network that we could tap on. So all these demonstrates that having a very strong sponsor who is aligned with the unit holders is very important. If our unit holders recall, in our last acquisition, our current sponsor also backstop some of the EFR, and this is clearly an alignment that the sponsor has with the unit holders, and we were able to execute the transaction successfully.
Yes.
Yeah. So in that regard, I would say that staying as a standalone REIT may pose some challenge, because right now we are no longer having exclusive access to a common sponsor. We are now going to share with ESR-REIT common sponsor, and we will have to compete with one another for the sponsors' resources. And not only that, we would have to compete with one another for third parties, pipeline, and tenant network. And what it means maybe, it could lead to price wars when we are, going after the same
And is that the
deal.
main reason that triggered out this merger approach?
Yes, the overlapping mandate issue is one of the
Main
consideration that we have to resolve. And the merger is the best option and the most optimal one that we have evaluated, and hence we are proposing this merger.
In fact, from your unaudited financial statements on 25th January 22, which you published, you did very well. NAV per unit went up from 0.57 a year ago to 0.67. DPU for 2021 is 5.045 cents. But you're seeing headwinds ahead. I must say kudos to you and your team. What is comforting is you and your team will be marching over to ESR in total. Nobody is left behind.
Yes.
The hardworking beavers are going over. Rental reversion for FY 2021 was a positive 3.1% also. You also had a committed occupancy rate of 99%. WALE is 4.4 years, quite a solid performance all around. So unit holders are clapping for you. But some say if they were to look at ESR-REIT, at the moment, the picture is not that rosy as ALOG, all right? Rental reversion was negative, 1.7% for financial year 2021, primarily due to tenants in the business park segment. Average occupancy is at 91.4%. WALE is shorter at 2.7 years. Not only that, NAV of ESR has been on a downward trend. It decreased from 40.5 cents per unit to 39.6 cents per unit in the last year. ESR-REIT recognized fair value loss of 40.8 million in 2021 based on the independent valuations. And in financial year 2020, it was a fair value loss of 58.8 million. So for ALOG, there was net loss in the fair value of your investment properties of 16.8 million in financial year 2020, but you quickly recovered to a fair value gain of 97.2 million in financial year 2021. ALOG also benefited from a significant net gain in the fair value of your property investments funds in Australia. Therefore, Karen, some unit holders tell me that they would be very happy if the proposed merger is for you to buy another ALOG. Can you find another ALOG? But unfortunately, there is only one ALOG. So how will you convince these unit holders that this arranged marriage, is inverted commas, with ESR-REIT is good because the existing assets and track record are good fit for ALOG? Okay, so that's one. I mean, what would you say to convince these unit holders who have taken a close look at the assets and the performance of ESR-REIT and think that this merger may dilute ALOG in terms of quality of assets, market trends, and the manager's track record execution? They are there looking at it this way. You please convert them. Can you?
I would say that, again, this is a recognition of, the teams, the ALOG's performance. And ALOG's portfolio currently is pure play logistics assets. And we know that logistics has been rather resilient throughout this pandemic. And this is due to the disruption in the supply chain. And it drives demand for warehouse space. So, generally, anyone who's in logistics business and sector will do well. But as countries starts to open up and we recover from the pandemic, we need to look a little longer term right now. And how to then, future-proof the REIT per se. The trend is going towards new economy assets. At this point, ALOG is a pure play logistics asset. We do not have any other asset class other than logistics, which is good. But for our counterpart ESR-REIT, they have a little more diversified portfolio. They have logistics and non-logistics, which are in the high specs as well. And the high specs assets are important because they will be driving and providing space for the higher value add manufacturing companies. And I feel that we do not want to miss out on the growth of the entire value chain from production to delivery. We want to be there. And by being alone on our own and having no other asset class, we may not be able to tap onto that growth once the economies open up. So that is why we think this merger is also to future-proof the REIT. And we have a clear strategy of how we can do that. The sponsors assets of 59 billion and 10 billion were in progress pipeline, and out of which 2 billion is actually executable and visible to us in the next 12 to 24 months. So we have a plan, we have a strategy of doing so. And we have never stopped thinking for our unit holders, even as we are busy with this transaction. We have completed our acquisition in January. We completed one of the Australia acquisition called Hero Property back then. And we have delivered those strong metrics that you have just mentioned. So we feel that at the end of the day, we as ALOG Manager prefers to look at a longer term strategy for the REIT rather than a short-term one.
Okay, let's take questions from
sure.
The share unit holders who are present tonight. I'm sure they have been typing in the questions. From Tan Leong Lai, on conversion to 1.7729 new ESR units, it means we'll end up with odd lots. For my 8,000 ALOG, I will end up with 14183 new units. Any arrangement to subscribe new shares to reduce odd lots?
Yes, this arrangement we have already put in place. The details are actually in the scheme document. So that conversion, the conversion of those odd lots costs will be borne by us.
Right. So answer is yes. Obviously, Matthew is asking, obviously things took a huge turn since we last met in January. Does management believe that the ongoing geopolitical tensions accentuate the need for this merger? Would there be additional risks now?
I think the geopolitical tensions could affect everyone, not just us.
Yes. Okay.
Yeah. So in fact, I think now looking at the future plan for the REIT, the risk to us right now is how do we grow ALOG moving forward in the future now with the
Are you saying the fundamentals
sponsor
will be strong?
Yeah.
Geopolitical and other factors may, like this Ukraine war and China American war between them, trade war, may affect that for a while. COVID has been affecting businesses. We hope COVID will be behind us. But all that out, you have tonight sold your case, and you're telling Matthew and the others, be with us, be patient. We'll grow this big picture soon and grow big, right?
Yes, that's
But
right.
will they get better DPU?
Unfortunately, I can't do any forecasting.
But you're hoping that, of course, with the better business, the bigger picture in place, they should be doing better. I mean, you won't be doing this if you think they will not do better in the long term.
And also, I believe a lot of our unit holders have actually held ALOG units for a long time. So that is why when we present this case to our unit holders, we got to explain very clearly how we are going to grow the REIT. Yeah.
Yeah. So they are comparing again Susanna Tan, which I did earlier, that ALOG is doing well, 3.1% rental reversion and 99% occupancy. This is start to ESR-REIT of 1.7% and 92%. How would you convince unit holders on this? How can you overcome that? Again, what are the factors that you hope that will be in place for the merger to do better?
Like what I said earlier, Susanna, as economies recover from the pandemic and countries opening up, I believe that each asset class could find opportunities in this recovery process. In my view, there will be demand for manufacturing, and the recovery process would allow us, when we come together as one single platform with a diversified portfolio, to tap on opportunities that may arise, post the pandemic.
Did you say this is going to be the 9th largest?
We will be the 9th largest S-REIT by free float.
Okay, so Jerome Lai is asking, what is the next acquisition step if the merger proceeds? And what is the next acquisition step if ALOG, if there is no merger?
I will answer the first question first. If the merger proceeds, what happens is that ALOG will be delisted, I think, in the first week of May. And immediately, Adrian and I will be working together to integrate the teams. And we will be aligning the processes and systems that both platforms have. So as two individual platforms, there are actually a lot of synergies we can harness, and becoming a larger REIT, there are also upsides from taking advantage of the economies of scale that we have. Some of these upsides are not factored in yet, per se. So there's a lot of things for us to do once the merger is completed. On the second question, if there's no merger, I believe we will still continue with what we are doing, but bear in mind that as a standalone REIT, like what we have been talking about, we'll be sharing
with the sponsor.
The same resources, and we'll compete with one another. And we may not be able to harness that economies of scale as compared to a larger platform.
Yeah, you've been using the broad term new economy assets, which consists of many sub-segments. Which asset segments does management think have this greatest potential?
It's a good question. So the new economy assets would largely comprise of logistics, high specs, and even data centers. So a lot of the assets now is, even for logistics, is no longer just a four-wall kind of space. At this point in time, we also see tenants asking for more technical specs to be included in some of the space that's being leased to them. So that is why we are tapping onto our sponsors' strong operational network to help our tenants create a bespoke solution for their business, so that they become more sticky to us.
Some ask, are you able to throw light on and share some light on the growth and business plan of the new merger? What can they expect?
I think there'll be a lot of exciting plans coming out. I think first and foremost, while we work on the integration of both teams, the evaluating and deep dive of both platforms to harness that synergies will be one of the key tasks that Adrian and I will be working on, to make sure that when we run the REIT, we can run it at the most efficient and effective way. The growth of the REIT is quite clear. We have the exclusive access to the sponsors' 59 billion new economy pipeline and 10 billion development in progress pipeline. So out of which 2 billion will be visible and executable to us in the next 12 to 24 months. So I would say that these will be some of the immediate plans that we will be Adrian and I will be working closely together to drive the growth of the REIT.
You are working too hard, Karen. You are getting more grey hair now.
Yes, I have a lot of grey hair already.
So take care, because they need you. You're going to go over and take care of the interests of the ALOG unit holders' interests, and they're expecting much more from you now. And any concluding thoughts?
Yes, I have been working in the REIT space for about 15 years and have been with LOGOS for 3 years. So back in August 2020, post the rebranding of Cash Logistics Trust to ALOG, I was actually approached to take up the new role as ALOG CEO. So at that point in time, Mr. Gerald, the REIT wasn't trading very well. So it was about 0.9 times
Yes.
price to NAV. And it hadn't grown much and had little institutional investor following back then. So regardless, I took on the mantle as I believe that the introduction of a strong sponsor, which was LOGOS, will be a good catalyst for the change. And we do have a clear plan. Again, a clear plan is important on what is the next steps for us to do to turn the REIT around. So in the last 12 to 18 months, not just myself, my team has worked very hard as well, and we took many steps to create that value for our unit holders. So this included the sponsors injection of the Australian portfolio, divesting a couple of non-core assets. We did a couple of defensive asset enhancements to make sure we preserve value. And we did a painful dilutive rights or rather placement back then, which was required for us to grow. So back then, Mr. Jai, I recall there was skepticism as to how we're going to turn the REIT around with a dilutive acquisition and a relatively new sponsor in the REIT space. So again, I believe a clear and sound strategy is important. And most importantly, we say what we will do. And we did it. The acquisitions, divestments, and asset enhancements were executed. And actions speak louder than words. So I'm happy to report to our unit holders that we have delivered our promise. And since the short span of last 12 to 18 months with LOGOS coming on board as a sponsor and me taking over the role of the CEO of ALOG, we've done well.
Thank you. And given your passion and your hard work, I have no doubt things would look better for you, unit holders. We've asked all the hard questions you wanted us to ask Karen tonight. And thank you, Karen, for answering all of them so diligently. And just for your information, unit holders, EGM is scheduled on 21st of March 2022 at 3 p.m. The scheme meeting will be convened at 3:30 p.m. as soon thereafter following the conclusion of the EGM. ALOG Trust Deed Amendments Resolution at the EGM requires 75% or more of the total number of votes voting at EGM. The scheme resolution would need to be passed by a majority in number of ALOG unit holders representing at least 3/4 in value. Unit holders need to note that the cutoff timing for the proxy form for the EGM and the scheme meeting are 3 p.m. and 3:30 p.m. on 19th March 2022, respectively. Unit holders can submit the proxy forms A, EGM, and B, scheme meeting electronically via the email. Thank you all for attending, and I hope that this session has been beneficial to you, and all the best to you and your team, Karen.
Thank you, Mr. Gerald. Thank you.